And our next speaker, Dirk, he had confidence when he was joining SaaSgroup because he did a career switch. Believe it or not, but he used to be an engineer in car emission testing, and he almost messed up his interview with SaaSgroup because he didn't know what EBITDA is, and now he's dealing with it on a daily basis. So one big round of applause for Dirk.
Can you hear me? Yes. Much better. Yes. So why can I talk about SaaS exit pitfalls? I'm part of a serial acquirer called SaaSgroup, so we buy SaaS companies, especially in the microcap space, so our range is between 2 and 10 million. And I have talks with founders every week about exits, and over the years, I've joined SaaSgroup 5 years ago, I've had hundreds or even thousands of talks with founders and came across many pitfalls they are running into when they approach buyers and talk about an exit. And so, first of all, I want to ask, who of you joined Imogen's talk this morning about exit? Okay, so quite a few. So you got to learn basically the founder's view of it. Now you learn the buyer's view of the whole game. And I will walk you through the 5 most common pitfalls founders are running into according to my observations, and we're going on a little adventure. And I asked ChatGPT about the most stereotypical Croatian founder you could think of. His name is Ivan, and he actually runs a business that could be relevant for SaaSgroup. So it's a bit above 3 million ARR, bootstrapped, PLG SaaS, small team, very capital efficient, profitable. And the guy has been running the business for 7 years. Usually the founders that approach us are somewhere between 5 and 10 years, sometimes a bit older. And he's thinking about an exit lately. And coincidentally, the guy, clicker isn't working. I keep the superhero pose while you fix it. Okay. Yeah. So Ivan is getting an email from me because we're currently exploring the space he's active in. He runs an e-commerce SaaS. We did some research. He landed on our target list, and I asked him to have a conversation about exiting. And so he goes on a little adventure because this actually brings him into the whole exit conversation, exit process game. And so we're playing a little game. We're going through the 5 most common pitfalls along the way and hopefully get to the treasure at the end. So the first one is what I call the golden mirage. Do you think you know what it is? I think it's quite obvious, right? So it's a common misconception of founders about what their business is worth. And it's not their expectation, it's what they think their business is worth. So you can still think, my expectation is 20x, but you should at least know what kind of the baseline revenue is, baseline valuation is when you talk to acquirers. And in 2023, I brought an example with me. I got this response from a founder. And this was actually not a joke. He was quite serious about it. He was asking for 35x revenue. And so that's a typical conversation I have about valuations. And I want to tell you a bit more what the market currently provides and what you can expect from buyers. And Imogen already pointed out where valuations are currently. And I also brought some actual market data. This is research from Software Equity Group. They are publishing a quarterly report on SaaS revenue multiples. As you can see, it's not ARR, it's trailing 12 months revenue multiples. And as you can see, the Q1 numbers are on the right. The median numbers currently are at around 4x, like 4.2x trailing 12 months revenue. And what you can also see is it's been quite stable throughout the last 12 months, so there was no significant movement. And I can tell you, I've been following those numbers for years, and there hasn't been like a super huge movement even during boom times. So for the SaaS M&A market, the multiples were somewhere between 4 and 5, always. What you can see as well is the average is much higher, and the median and the average are drifting apart. Why is that? There are very few what investors would call great assets. So there's little supply but high demand from acquirers to own these assets, and they drive up the average. So there are a few high deals, like very large deals happening on premium multiples, and then there's the other side of the iceberg, the bigger side actually, with a lot of transaction happening at very reasonable multiples. And so this is kind of the baseline. And the biggest issue I usually have with VC-backed founders, because they raise some rounds, and this is on dream numbers and on future potential of the business. And so also, to put it into perspective, brought you the recent VC multiples from US. So this is data from Carta, also from Q1. And currently you can get in the US a 60 million valuation for a SaaS business. And if you take the typical milestones for a Series A, that basically means a 40x revenue that VCs currently pay. And then you see on the other hand, if you want to have a typical market multiple in the private market, if you're selling your business, it requires 15 million for a similar valuation. And so what you need to know if you raise VC, you might face discrepancies when you enter exit conversations, and it might not be the last round's valuation. That's kind of the entry point for negotiations. Here are the typical valuation factors. I don't know if you can read it, it's quite small, but I can maybe summarize it quickly. I think Imogen also told you about it. ARR growth, revenue growth is still the biggest valuation factor. You can see this in the public market, you can also see it in the private market, but what buyers value as well is just efficiency. And that's on the one hand, operational efficiency. What are your margins, your EBITDA margins, your cross margins, your rule of 40, all that kind of thing. And then it's go-to-market efficiency, so LTV to CAC, CAC payback, etc. And lastly, it's retention and churn dynamics. So companies with a high upselling potential, with great net dollar retention, maybe even over 100%, get greater multiples than maybe a business that has only 70% net dollar retention. The issue here is sometimes that's a natural thing of your business that it has lower retention metrics, and you just need to be aware that it has some consequences when you're going into exit talks. So you can't get a premium multiple when you have like a B2C kind of SaaS business that has very low retention. It's more of like living off one-off usage. And so to accomplish the first level, like the Golden Mirage, I would recommend you run a simple DCF analysis. Who doesn't know what that is? Okay, so I would say that's what brokers are doing as well, right? Would you confirm? And buyers doing too. So basically they build a forecast based on past metrics of your business and market factors like market growth, competition, and so on. And they would do a cash flow analysis of your future cash flows. And ultimately, the intrinsic value of your SaaS business is just the present value of the future cash flow potential. And so if you're forecasting whatever 600K cash flow in 3 years, someone might be willing to pay 300K today because there's a certain risk that those cash flows will not come or whatever, market development. So you basically accept the discount to future cash flows when you sell your business today, and you get certainty for it. So you can Google it. I can also give you some tips on how to run it very simply, and it gives you an idea of the baseline valuation of your business and the intrinsic value. Secondly, it makes sense if you check KPI benchmarks and the multiples I just showed you to see how you perform against the market. Are you growing faster than the average business? Are you growing slower? Are you more profitable, less profitable? How's your retention against the market? And then you can also get an idea where you rank. And if you blend those both methods, you get at least a ballpark number, and you see whether it's like 10x or rather like 2x. And so I think it's a very helpful exercise for founders to make to see where they stand. Second level. the procrastination pit. And there are actually 3 aspects to it. So first of all, I meet a lot of founders that, in my opinion, waited too long to exit because they already stopped enjoying the ride like 2-3 years ago, and they thought, hey, I can bring it a bit further, and I want to launch that product, and I want to build that feature, and I want to reach 2 million, and then I want to reach 3 million, but they're not enjoying the ride, and it has consequences on the whole business, in my opinion, because then they're not running on full steam. And what happens is, if you look at a typical growth curve of a SaaS business, it's typically an S-curve, so you're trying to figure out product market fit, you're starting to grow, at some point there's kind of a growth decay. And a lot of companies I talked to, they already ran into this growth decay when they should have sold maybe with a bit more steam 1 or 2 years ago. The second aspect about procrastination is that it takes quite some time to build relationships with potential buyers. So especially with strategic acquirers, if your goal is to sell to Microsoft, you better start today talking to their corporate development team to pop up on their radar so they are aware, they keep track of it in their CRM. And even for SaaS Group, it takes quite a long time. I brought some numbers on the next slide from our most recent deals. And these even blends in broker deals that are usually a bit faster. And it takes over 600 days from I met the founder at a conference, I had a first discovery call, whatever, like first point of contact, to ultimately closing a deal is almost 2 years. And so if you remove the broker deals, that's actually even longer. And so you really need to plan for that, and it really increases your chances of getting a right exit and getting a good exit and getting an exit in the first place tremendously. And the last point about the procrastination is what I'm seeing too, that many founders think, okay, now an exit is imminent, I want to find a buyer, but before I maybe do some steps to increase valuation by raising prices, selling annual contracts on a bigger discount, or fixing some technical debt on short notice. So everything happens in that year before exit. And I can tell you more often than it goes right, it goes wrong and it backfires. And I brought you this concrete example we looked at a few weeks ago. The company was flat, not growing for the last 2 years. As you can see, these are the annual cohorts. They became smaller and smaller, so they really struggled to acquire new clients. And they thought, hey, with 0 growth, not a great valuation, not a great negotiation position, let's raise prices to show at least some growth. And what happened here, it created a disconnect between value provided and the price of the product, and customers started to churn in masses. And so from a flat business, they ended up having a declining business and went basically from a, let's say, 2x market value to a 1x market value, because this is a distressed asset. That's how we call it. So to sum it up, start exit preparation early enough, like 2-3 years. You can even start talking to buyers today or to advisors or whatever, but like think about it and think about good exit channels. Get in touch with them, and don't do short-term window dressing in the year before you plan to exit. So really try to build it in advance, document your code base, document processes, build a proper org chart, show a buyer what your reporting lines are, just clean up that mess you may have created, and don't try to do it in a couple of months before you actually exit. Level 3, data vortex. Do you know what that means? Any idea? You are familiar with it, you're laughing. Not being able to provide the data buyers are requesting. And you might think it's clear that buyers ask for a proper profit loss statement, for MRR data, and still even founders actively seeking an exit don't have that stuff ready. And the thing is, for example, with SaaS Group, we aim for 5+ acquisitions every year. If it takes you 4 weeks to compile a proper data set, we will turn to the next best opportunity, and your opportunity will be gone. And this also applies to many other buyers. If they are a strategic acquirer and they mapped out the market, I mean, you maybe saw it with Cursor and Windsurf, with OpenAI. I think they talked with Cursor, they were not interested. Well, then they turned to the next one and tried to buy it, and so they closed Windsurf. And this is what happens across the board. So you really need to be careful that you might lose out on a great exit opportunity if you don't have that stuff ready. And this isn't a P&L. So actually, this is, I mean, I rebuilt it with those random numbers, but that's something a founder has sent me, actually, because I requested a P&L. And do you know how that feels like? It's like this. It's basically a fuck you. And if you're actively seeking an exit and you send a P&L like this, I might not move forward with you. And so what I would prepare is, I would call it a SaaS exit starter pack, an NDA. So you're free to share data with buyers. So ask a lawyer. You can also find templates online, a lot. So prepare an NDA, prepare a proper SaaS P&L. There are templates online, how this needs to look like with the proper items, your revenue streams, your cost of goods sold, your OPEX items, so a buyer gets a good idea. And ideally, you can provide it on a monthly basis and not just your annual reports. And then on the right, I think the numbers are a bit small for you to recognize, but this is a so-called MRR schedule. So it shows an anonymized list of all your customers and their revenue, like their payments on a monthly basis. And this allows a buyer to basically calculate all the basic KPIs themselves, because they usually don't trust you, at least not at the start. And over the years, I had very weird things that landed in my inbox. I mean, people sent me weird screenshots from their ChartMogul account or whatever. Buyers want to work with those numbers. They build their models, they work in Excel, they work in Google Sheets. I think our head of M&A might hate me for mentioning even Google Sheets, but in Excel, and they want to build a model and, again, run this DCF analysis, which I mentioned, and so provide proper data that they are requesting. So to accomplish this level, level 3, track metrics in a buyer-ready format. That means spreadsheet data, ideally monthly basis. And I think Imogen also mentioned 3 years plus of historical data and not just the last 6 months. Level 4, the pitch labyrinth. Very often, I have discovery calls with founders and they pitch me their great intellectual property they've built. Great product, and it's not reflected in the numbers yet, but it's about to skyrocket tomorrow, and it's much better than their competitors, even though they are way ahead, highly VC funded, and they basically have a stellar business, but the revenue didn't come for whatever reason yet. I don't want to hear it, because that's not what our focus is as an acquirer. And so you really need to do some research yourself if a buyer approaches you, to think about what's the interest, why they're approaching me, how could you fit into their bigger picture, and then adjust your pitch accordingly and try to highlight the things they are ultimately interested in. And I brought a slide, which is like a kind of Tinder dating-like app. And I mean, there are hundreds, thousands of different buyers, but if you need to narrow it down to just a few, I would say you can divide it into small PE funds, also serial acquirers like SaaSgroup, roll-ups, whatever. They are aiming for smaller companies, maybe smaller targets. They keep them, they protect the legacy, they keep it running as is, they maybe group it like we do. And they are looking at fundamentals, they're looking at your numbers. They want to buy companies that have great retention metrics, they have companies that have growth potential, have maybe a good historical numbers, and they look at your data. You don't need to highlight your IP unless it's reflected in the numbers. Then you have what I would call finance bros, the Patagonia West mafia in the middle. Large PE funds, they are usually building a platform. So they want to acquire a couple of companies, basically stick them together, and then flip them to the next best buyer after a holding period. And they are seeking complementary businesses, so they are usually putting a huge focus on fundamentals, but also on synergies with their existing portfolio. And so if such a buyer approaches you, you want to highlight your fundamentals, but also the synergies and how you fit into the bigger picture. And then on the right, Satya Nadella, standing for the strategics here. So if you're aiming to sell to a VC-backed competitor or a PE-backed strategic or even like one of the public market dinosaurs, then the only thing they are looking for is intellectual property. So they are multi-billion-dollar businesses very often. If they brought you and you highlight your great net dollar retention, they couldn't care less. That doesn't bring them anything. So actually I listened to a talk of the head of corp development, the former one of Microsoft, and he gave a talk on how to sell to Microsoft, which was very interesting. And they said they basically have a year-long cycle, and at the beginning of this cycle, they decide buy or build. So they analyze what could it cost to staff a team and build it themselves or acquire this IP outside. Then they decide what they're going to do. They map out the market, they approach those companies, try to negotiate a price, and then buy. Or if they come to the conclusion they can build it faster and cheaper, then they would just build it themselves. And so you really need to highlight your intellectual property, and you need to make sure that it builds on their existing mountain, because they would not open up a new mountain necessarily for your small business. So to sum level 4 up, tailor the pitch to the investor type. So if you're talking to a more financially oriented buyer, highlight your numbers. If you're talking to a more strategic acquirer, highlight your market access, your customers, your IP that you've built, depending on where you see the strategic fit. We're already coming to my last point, and I think, Jekko, you will like it. The single buyer cliff. So I'm actually sensing if I'm the only buyer you are talking to. At least I think I do. Sorry?
It's like Tinder.
Yes, yes. And so your level of despair shows up when you talk to me, and I notice it, and it gives me leverage in the negotiation. And you don't want me to have leverage in your negotiation. You want to be in a stronger position. And so even if you only talk to me, at least pretend you're not only talking to me. But ideally, you talk not only to me. So it's a bit like fundraising if you're a VC-backed company, and it actually can be a full-time job. So if you think that's overwhelming, I don't know how to approach this, get some help from advisors. There are multiple advisors here, so you can ask them some questions too. But just make sure you approach multiple buyers, also to be able to compare offers against each other and to know what are they offering, what's their value proposition, how do you fit into their company, conglomerate, whatever, just to have optionality ultimately and to see where the prices land, what kind of multiple you can get. Strategics, again, might be able to pay more, but the likelihood of small SaaS companies selling to strategics is maybe lower. So it depends. And if you have a broker or an M&A advisor helping you, they are professionals, they know how to negotiate, they know how to take on those conversations, they can map out the market, build a list of acquirers, and they can really help you. You don't get it for free, but if you think, okay, I need some help there, it could ultimately get you a better offer, and you can outsource basically part of the negotiation. I also want to quickly touch upon common deal structure components, because a lot of founders are not familiar with them once we put an offer, and I need to explain it. So just quickly, on the left, cash is, I think, self-explaining. It's the cash you get on your bank account once the deal closes. So this is a typical component. You will always have a cash component. I wouldn't accept another deal where I don't get anything at closing. I see that happening maybe in the micro-cap space where you're trading your hobby project, but definitely not if it's a sizable SaaS business. Second one, seller financing. It's basically buy now, pay later in M&A. So basically it's a delayed payment of the purchase price. And it can sometimes help to bridge valuation gaps, because it allows the buyer to amortize the deal from day one, but pay you part of the purchase price a bit later. So a lot of M&A deals are leveraged buyouts, so they take on debt to finance the transaction. If they could take on debt a bit later, they don't need to pay interest on it, etc. And so they can go a bit higher with the valuation. It's basically a loan you give to the company. It matures with an interest rate. And so if you say, okay, I didn't want to buy a Lamborghini anyway, I can wait for this money, then you can basically get 5 to 10% interest rate on it on an annual basis. Third point, earnout. I think that's also been discussed this morning. Always contingent on you staying on board and contingent on performance milestones. Could be revenue growth related, could be profitability related, depends on what the buyer wants. Could also be related to integration projects you need to complete. That's what we sometimes do if there's technical debt and the founder wasn't able to catch up. We take this as a contingency for the earnout. And then the last point, which can be great but also quite risky, is equity rollover. So it's basically you're trading your shares for the acquirer's shares. I can tell you some horror stories about it. I can also tell you some big wins about it, both sides. There was actually one story where a founder got offered, like we've been in touch with them, they got offered a really big amount from a strategic acquirer, but they offered 2/3 of the deal amount in an equity swap. And our offer compared to their top line number was lower, so they opted for the strategic acquirer. In the meantime, the strategic acquirer raised a down round, and they got common stock, not preferred shares like VC investors, and there's basically over 100 million in liquidation preferences above them. So basically, they built a company over 10 years to, I think, also 3-4 million ARR, sold it for a great amount, but walked away with a few hundred K. And I recently catch up with the founder. He renovated the living room for it. So both sides. So you need to trust the acquirer, and you need to have confidence that they can deliver, because your return on that equity rollover is directly tied to their performance. So last level accomplished if you run parallel conversations. So try to build up some competitiveness in the process. It also allows you to compare offers against each other and ultimately pick the one that sounds reasonable, that best fits your preferences, and where you see a good new home for your baby. And yeah, just create, if you can, a competitive timeline and stick to it. I also sometimes have founders that try to follow this advice and they say, yeah, we need an offer until next week. And then I said, okay, that's not something we can deliver on. And then they say, okay, yeah, it's also fine if you send it a week after. That's not a competitive timeline. If you don't stick to the timeline, then just drop it completely. So this is my cheat sheet to quickly accomplish all levels. Golden Mirage, get a good understanding of what your business is worth. Again, it's not expectations, it's what your business is worth. Second one, procrastination pit, try to prepare early enough and fix issues in advance and not on short notice once an exit becomes really imminent. Data vortex, prepare the data in a buyer-ready format, spreadsheet data, monthly basis, MRR schedule, profit loss statement. Ideally, you have an NDA ready as well, so you can quickly send it over and get it signed. Then number 4, pitch labyrinth. As I said, there are multiple buyer profiles. Do some research on your own. Try to figure out what are they up to, what are they doing, what is their model, how can I adjust my pitch accordingly. And then the last point, the single buyer cliff. Try to run a competitive process if you can. And so if you follow those steps, I'm pretty sure you will have an epic win at the end. Thank you.